I'm here outside the IFSC, which is home to over 500 companies generating 2.1 billion euros a year. Many of these companies pay little or no tax.
The IFSC was the brainchild of businessman Dermot Desmond and Charles Haughey. Desmond is the 7th richest person in Ireland with a wealth of over 1 billion euros and, not surprisingly, a tax exile. He has taken part in several tribunals where, amongst other accusations, he has been accused of giving large sums of money to Fianna Fáil politicians, including Charles Haughey. Tax evasion in Ireland is not restricted to wealthy individuals such as Mr. Desmond. Large corporations such as Apple, Google, Microsoft and Starbucks have all used various schemes to avoid paying taxes on their profits. Ireland is ranked by Forbes as one of the top 10 tax havens in the world. Recently, vulture funds have moved into Ireland seeking to profit from the housing crisis while also avoiding paying tax. I spoke to Brian O'Boyle in our studio about how these schemes work and what the implications are for the Irish people.
So I'm here in the studio with Brian O'Boyle, who's an economist. Brian, tax havens have obviously been in the news a lot recently, particularly with regards to the Apple case. So could you define a tax haven for me?
Yeah, well, I mean, the first thing is the name, a tax haven. So it's a haven usually for very rich people or corporations from their taxes. Second key thing is about secrecy. So, for example, Switzerland has famously secret laws on wealth. So rich people have a strong incentive to put their money there, knowing that people can't find out what money they have there, and therefore it's very hard to tax it or to have any democratic control over it. And the third thing then is about regulation, or the rules or the laws. Tax havens tend to write their financial policies, their tax policies, with the big corporations in mind. So in other words, if you get captured by the financial industry, usually you're seen as a tax haven. So it's either one or all three of those, whether or not your tax policy, whether or not you have secrecy, and whether or not you have regulations, very light regulations. They really define whether countries are defined as a tax haven or not.
Okay, and describing those categories and that definition, do you think that Ireland fits into that?
Well, yeah, I mean, the first one that everybody probably watching knows about is the 12.5% corporation tax. So Ireland has a famously low corporation tax, and it's quite interesting that even children in Ireland, young students, understand that we have low corporation taxes. Now, that's an unusual state of affairs. If you went to most European countries, they don't know how much corporations which they don't own are being taxed. So the Irish are very clear on the importance of a low level of corporate taxation, unlike, for example, high levels of VAT or income tax on workers. The second one, though, that's less well known is the secrecy element. In Ireland, there's a department of the Taoiseach. Within that department, there's a whole series of institutions set up to protect what's called the Irish Financial Services Centre. One of the most important is called the Clearinghouse Group. Now, the Clearinghouse Group meets on a monthly basis. It's made up of representatives from the Revenue Commissioners, from the IDA, from various bodies like the Department of Finance, and also the big bankers. So you've got BNP Paribas, you've got Bank of Ireland, you've got Citibank, etc. So and finally you've also got a lot of the accountancy firms like PwC and all that. So in other words, you have a whole group of people who come together on a monthly basis to look at how they can facilitate the development of the Irish Financial Services Centre, including tax policy. That leads on to the third area of whether or not Ireland is captured by this. And one very stark example would be in 2011, at the very height of the Irish crisis, the Irish government was preparing to ram through austerity on people, which actually led to an almost doubling of, over the course of the crisis, a doubling of rates of deprivation. And at the same time, they were putting through very specific policies to make sure that people who were executives in companies could come to Ireland, and any money they earned over 75,000 would be very favourably taxed. In other words, they were giving tax breaks to executives at the same time as they were undermining people's living standards. So on all three counts, on the low levels of tax, on the high levels of secrecy, and on the levels of regulation, Ireland is definitely a tax haven.
Okay, so you talked about the IFSC there. Some people would be aware of funds like vulture funds that operate from the IFSC who are coming to Ireland, and basically people have been forced out of their homes because of them. Could you tell me a little bit about how they operate here?
Yeah, I mean, a vulture fund, first of all, the idea of the fund is important. Banks are heavily regulated because they are so important in the economy and they can cause a lot of destabilisation. As we know, the Irish crisis of 2008 was mostly caused by bank decisions and the decisions of key bankers. But there are a whole series of institutions which is called shadow banking. The reason it's called shadow banking is it's in the shadows, and vulture funds are part of that system. Effectively what it means is that these funds act a bit like banks, but they don't have regulation. And they're owned by rich people, and those rich people have one motive, which is to make as much profits as possible, and they usually do it in distressed markets, where the economy has crashed, and therefore they're seen as a vulture, because like a vulture, they pick on the weak and the vulnerable, and they pick over the carcass to make sure that they make as much profits as possible. That's what a vulture fund is.
How do these vulture funds actually operate here in Ireland?
Okay, so yeah, the way it links, it's quite a complex story, but I'll try and be as quick as I can. In the first instance, in 1997, there was a policy enacted called Section 110, okay, 110. And that was effectively to attract what were called special purpose vehicles to Ireland. A special purpose vehicle is really just a legal entity. It separates the legal framework of one part of a company from another. So for example, Bank of Ireland is a legal entity. It could have another institution called Bank of Ireland Limited or Bank of Ireland Incorporated, and that would be separate even though it's run by Bank of Ireland. And the advantage of this is you have two entities now that can kind of move and work with each other. Now, the reason why it was done in 1997 was to allow for various institutions in the world to manage parts of their funds through Ireland. And so people like Charles Haughey and Dermot Desmond and so on, they understood that if they made these regulations very light, they could get money to flow into Dublin, and that would then give them a fee for managing the fund. Now what has happened is, first of all, two key things happened. One was, in the crash, obviously the property market completely collapsed. Now, in order to defend what they said was the assets and not have a fire sale, they set up NAMA, the National Assets Management Agency, and that was meant to manage assets in the national interest. That's what it was for, national assets. And it was explicitly about holding on to assets so that they wouldn't be fire sold. Now, in the event, they did the opposite. They actually sold them off really, really quickly. And 90%, up to 90% of those assets went to these vulture funds. So in other words, in the first instance, there was a mass sale and the sale went to rich people. That was the first point. The second point then is that these vulture funds were given a special twist on the Section 110. So if they set themselves up as a separate company, this is what they could do. So imagine a vulture fund has two parts. Let's say it's called Cerberus, because that's one of them. Cerberus A and Cerberus B. Cerberus A is the parent company. Cerberus B is the Irish company. As long as you have 10 million of assets, of course, because they only want to help the big guys, not the little guys. As long as you have 10 million of assets, you can buy up Irish assets. And you can do that using money from Cerberus A, but crucially, you can define that legally as a loan. Now, say for example you make 20 million profits on the Irish property. What happens then is you can then take that 20 million as profits, but before you pay any tax on it, you can declare up to 20 million of it as costs for interest back to your parent company. So in other words, you can say that we made money in Ireland, but we made it through loans which we got from an outside company, but of course the outside company is yourself. So you're taking money from yourself, you're using that money to buy assets, those assets give you a profit, but then instead of paying tax on the profits, you can say, actually, we need to pay back the cost of our loan, and miraculously, the cost of the loan is almost always the same as the amount of profits. So for example, they could make, 44 or 45 million, and then they could represent that as 45 million in profits, but they've got 45 million in loan costs, so therefore they're profit neutral, no profits, which means no taxes.
Okay, so that is a different way of avoiding tax from, for example, what Apple did. Is that correct?
That's true, yes. Now, but just before we go on, I just want to say one other thing about it. I mean, the amount is staggering. First of all, the Irish Central Bank have estimated that the vulture funds, alongside a number of other international institutions, have bought up 300 billion euros worth of Irish assets. I mean, that is phenomenal. That is about 2.5 times, or at least 2 times the size of the Irish economy. So you're talking about such vast amounts. Now, the Sunday Business Post looked at some of the accounts of the vulture funds, and what they found was effectively that in the start of the year in January, about 20 companies had given their end of year results. Those companies had a collective asset worth of 20 billion. So in other words, in Ireland, they had 20,000 million euros worth of assets. Do you know how much tax they paid?
No.
20,000 euros, which means for every 1 million euros of assets, they paid €1 in tax. Now, Stephen Donnelly has done some work on this, as have the Sunday Business Post, and there's a sort of a consensus that the Irish Exchequer is losing somewhere between 1 billion and 2 billion euros on this. Now, when you think about how much attention is given to people who maybe, are on welfare and they get an extra payment, or people who, they talk about benefit, what about the corporate welfare that's going on in the country? In other words, while people are forced to look down at the people who are getting a few crumbs, meanwhile, the cake has been robbed by the big rich. So it's really important that the viewers understand the magnitude of the money that's been taken. First of all, they got the assets at really low prices. I mean, that was fire sale. Then they made profits. Then they paid no tax. It's a win-win-win for the rich, and it's a win-win rich for the foreign rich and the Irish rich.
And then just to go back to Apple, can you tell me a little bit about how Apple's tax situation has functioned, and obviously the outcome of the European courts and all that?
Yes. Now, again, there is a similarity and a difference between how the vulture funds work and how Apple work. In both cases, you need two legal entities, and you try and play legal games between them so that you reduce your profits on paper and then you pay less tax. That's what they're effectively doing. So let's look at the Apple case. Apple have a genuine company in Ireland, but they also have two what you might call paper companies. And what they do is they take all of the profits. First of all, these companies are legally incorporated in Ireland. In other words, there's no doubt that they have a legal standing in this country, and therefore whatever happens here has been sanctioned by the revenue commissioners and by the government or by the state, right? And what they say is, okay, even though the Apple employ over 1 million people in Europe, right? But they're somehow able to declare all of their sales in Ireland. So obviously the sales are happening in Germany and France and all the rest of it, but they're able to declare the sales in one of the companies in Ireland. So one of the companies here is massively profitable, okay, clear? And then what they do is the company one that makes all the profits has to pay royalties to company two. So there's one company that declares all the profits, and there's a second company that gets all the royalties. But crucially, that company is not resident in Ireland for tax purposes. So it's incorporated here legally, so it has legal protection here, but it's not legally bound to pay tax here. So the money flows in, hundreds of billions have flowed in. They are protected by Irish law, but then instead of actually being due for Irish tax like everybody else, they can then actually move them offshore. And what the European commissioners have said is that they're effectively tax liable nowhere because the company has no host country. So that the profits don't flow off into, say, America or whatever. They just get they flow into basically Apple's back pockets. That's what happens. So it's called the double Irish because there has to be two companies, both of which are legally incorporated here, one of which is usually liable for tax purposes and the other which isn't. The one that's liable for tax purposes can trade and get all the profits, and then it sends them on to the other one, and that's what they've done. And the reason why it's 13 or so billion is because the European commissioners have estimated that the company have about 104 billion of profits, and the 12.5% corporation tax should apply if they're going to be taxed the same way all other companies are. So even that very low rate of tax would give you the 13.5 billion.
And that's obviously why they said that this amounts to state aid to Apple from the Irish government, basically.
Absolutely, and I mean it's pretty much, I would say, an open and shut case, because without the legal protection of the Irish state, in other words, when you incorporate here, you're using the Irish legal system. You have to be given permission by the Irish country to do that. And when you incorporate here and then you are allowed to, say to German tax authorities or to French tax authorities, don't worry, the taxes are not due there because they're due in Ireland, but then when they get to Ireland, they vanish. So that is aid from a state to a company. I would say that's a pretty obvious case of state aid.
Okay, Brian, so there's some people who would argue that we should just leave these companies to do what they need to do because actually they help to grow the Irish economy. What would you say to that?
Well, I think it's a very narrow view. First of all, I think it's quite an immoral view as well, because if you think about it, first of all, there's a very important group out there called the Tax Justice Network, and they have estimated, and again, because of so much secrecy, it's hard to get a definitive figure, but they've estimated that there's about $25 trillion in tax havens. Now, that comes basically from the hard-working people of the world. If you go back to the Irish property market, how could the vulture funds in the first instance have gotten the property if Irish workers didn't build it? I mean, the work that goes into an economy is done by the working people of that economy, and the vultures come in afterwards. And in the basis here, you're talking about, even if, workers in Ireland are taxed at usually 20% for their income. If you taxed these tax havens at 20%, there's an estimate out there that you could solve world hunger for 125 years. So in other words, it's a very narrow, short-sighted view to say we should just continue to help these very, very rich people to get away with this, and at the same time just not worry about the poor in the world, the vulnerable, the marginal who are being undermined. So I think it would be much more progressive and a much more defensible strategy to say, let's have taxation harmonization. We're always hearing about the idea that we have a European Union. Well, let's have a union then that actually says to the corporations, pay a consolidated amount of tax. In other words, let's make sure that they can't play countries off against each other and move around the world. Because this argument about we have to just look after Ireland is also being said in every other country. And so by doing that, you set up the rules so that the rich can basically play countries off against each other. So I would say if we're living in a democratic world, which we're supposed to, then democracy should say that countries should come together and stop the ability for countries to move into tax havens. So that would be point number one. If you don't mind, I'll say a few other points. Second point would be, whether it's child slavery, whether it's sex slavery, whether it's drug proceeds, because they're so secretive, tax havens allow for the wealthiest people, both on the one side of the law and the other, to move their money through tax havens. So if there was no tax havens, it would be much more difficult, for example, for the drug barons in Mexico to wash their money. There was a famous case where HSBC, one of the biggest banks in the world, was fined billions for allowing the drug cartels to launder billions of their profits. So it's not only a case of, the immorality of it in that sense, it's also a case of it facilitates all of the most important criminal activity in the world, illegal drug sales, illegal gun sales, all that kind of stuff happens because of tax havens. The third key point would be the level of disruption it causes to the financial system. If you have, trillions, the Irish shadow banking system apparently, according to the Financial Times, is the joint third biggest in the world. It's 10 times bigger than the Irish economy. Now, if those kind of, dark areas of the global economy are left unregulated, they have a very strong potential to destabilise national economies, driving people back into crisis, driving companies into crisis and unemployment and everything. So if we're so worried about regulating banks, why would we not have any regulations on tax havens? Two last points I would make. One is these things are actually not sustainable. If you think about Brexit, or you think about Trump, or you think about the Europeans trying to have a consolidated tax base now, Ireland is in a very sticky situation because increasingly other players in the global system understand that Ireland is using its sovereignty to write a blank cheque for big business. And obviously they don't have any moral problem with that, but they have a technical and a strategic problem with it, and it's becoming more difficult for Ireland to get away with this. So I would argue, whether it's the moral argument, whether it's the destabilisation argument, whether it's the morality argument, or whether it's about just the decency of actually having democracy, having some democratic control over money and over finance, I think it's very important that we have a different vision for an economy that actually starts from giving more democratic say to the people in the country and allowing them to make key decisions about how we develop our economy moving forward. So I would be for challenging the power of the 1%.